Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler. Joined today, do I announce it for Dan Hill is actually in the house. Man, and Evan Barnard, of course. Of course. Not I mean, of course.
Dan
not always here.
Dan will have the lower voice of the two of us.
Go ahead, speak
Welcome.
to us.
Welcome, everyone.
Yeah, nice. Well, it is good to be with you guys. It's. I think we'll have some fun today. I have a feeling if we can dodge the thunderstorms for long enough, I think that's what's coming on. I was gonna ride my bike over here, and I got a bike, Dan.
A Harley? You got a Harley now?
No, not that. One that you actually get exercise on.
Not electric.
It is sort of, it's assist, because there are some hills between here and my house that I do not want to go.
It's solar powered.
It is not solar powered.
I don't know why he didn't ride his horse over here.
My horse? Oh, gosh. Yeah, that's funny. Yeah, so if you're wondering what he's talking about. So my wife, the other morning, Nick, my wife says, "Look outside." And I'm like going, "What?" And I'm doing something else. What? Look outside. What? Now, hang on, I'll be there in a second. No, look outside. I'm like going, okay.
Bigfoot.
So I'm thinking maybe there's a deer out there. Maybe there's a turkey in the, because that's, typically what wanders through the yard is something like that. No, a horse.
Yeah, of course.
No, yeah, of course.
Of course,
and it was not Mr. Ed. Yeah, it's just like, what? A horse in the backyard? So I'm like, and this thing is the most mischievous little horse.
Yeah.
I mean, he's like biting my arm. He's biting my arm. He knows he's nibbling on my wife. I'm like, stay away from my wife.
That's my wife. Stick to the carrots. Stick to the carrots.
We're giving you some oats. We're giving you some molasses. Leave my wife alone. And then come to find out, it's one of the neighbors who happens to be none other than a Fox News guy. Oh, cool. So I'm just like, okay, this is fun. All right, this is really interesting. Yeah.
If it was a liberal, you'd have called the police. But since it was a Fox News guy, okay, I'll be a good neighbor.
So it was one way or another we were going to meet this guy, and that's. But he was off at the RNC, so he had to have somebody else pick it up. But it was just funny. So yeah, that's the horse reference. Yeah, it's been one of those weeks. Yeah. There you go. So I don't even know where to start today. There are lots of things to be talking about. Where were you last? I always.
It's not like there was any news this week.
Last Saturday,
Since
right?
The show ended.
That's what I said. I'm not even sure where to start. There was so much stuff that happened this week. I know Evan, Dan, you guys probably have comments on because last week, the show was in our third hour, and we ended up getting preempted for what was happening, and it was absolutely shocking.
Oh yeah.
And when I got home, my wife's like, do you know what's going on? I'm like, okay, yeah. And of course, everybody, you had texted me, "Are you watching?" I said, "Yeah, I'm riveted as to what's going on." And looking at the scene, and just looking at the grounds where this was taking place, I'm going, "This is pretty obvious." This building, and a lot of people have spoken about that. I don't know that we need to go down that avenue, but I think for the markets, because we talk about stock markets, anything like that, you go, what moves markets? Both up or down. And in the early part of the week, you're looking at markets jumping up for whatever reason. Maybe possibility of that
about
nothing
900
actually
points
happened.
The first couple of days, about 900 points, I think, between the 2 days.
Yeah, pretty significantly. And then toward the end of the week, it goes down. You go, well, why did the market go down? And I think you could make the point that the market does not like uncertainty.
Right.
And it's not that profits had a chance to change whatsoever toward the end of the week, but simply the fact that if we have uncertainty as to who is going to be in the election, who the candidate's going to be.
Right.
We know who one candidate's going to be so far. That was a close call last week.
Which one is that, Paul?
Yeah, well, what I'm saying, a close call last week. But, the second candidate, we're sitting there going, are we going to get an announcement?
Right.
You don't know when or what's going to happen.
Yeah.
But the market doesn't like the uncertainty. So what happens is the only thing you can change, you can't change what the profits are going to be of the company right away. It'll take a while for profits to change, but you can project what profits might be or what they might not be. So some events do change markets immediately based on expected profitability going down. But if you're looking at nothing necessarily changing profitability 2 months, 3 months, however
2
many
years,
months in the future,
Right.
the only thing that you can actually change is the pricing. And when pricing goes down, when stock prices go down, basically what's happening, if there is nothing that necessarily changes earnings is taking place, then your expected return in the future is actually going up because investors who are willing to buy stocks in times of uncertainty pay lower prices. So the example I gave, literally the night that when Trump was first elected, when he was first in office in that night of election, I was on with... there was Michael Del Giorno, Dan Mandis was on there, Phil Valentine was still around at that point in time. And they were like, Paul, get up on the stage. And the example I gave on the stage that night, because they were talking about the futures being down so much, is, okay, let's say that stocks are selling for 20 times earnings. Okay, let's say that is what's going on, and that you turn that number over, you're getting $1 of earnings for each $20 you pay. The earnings yield has gone to 5%, right? 1 divided by 25%. If all of a sudden, to use an extreme example, that now there is more risk in the markets, and now we need a 10% return or a 10% earnings yield, just to keep the math simple, what will have to happen to price? It will have to go to $10. It'll have to go from 20.
Drop 50%, yeah.
Yeah, it'll have to go down to 10. So in essence, what will happen now, my new earnings yield is 1 over 10. Would you, as an investor, say, oh, it's great, it's time to sell. The expected return has just gone up. No, that doesn't make any sense.
Yeah.
But that's what, people, when they get panicky about these types of things, they don't think about that particular aspect of things. But, it's been a busy week.
Yeah. One of the things that you mentioned in that first couple of paragraphs that I was thinking about Thursday and Friday was to the point that nothing materially changed. I mean, Trump was hit, went down, came back up, but he's fine. That didn't change the amount of Pepsi that people were buying. It didn't change the amount of gasoline people were buying. Phones, trips weren't canceled. I mean,
right.
Economically, nothing materially changed, but people's expectations of what might happen, news, new information, they reevaluate the certainty of all of those things, even though nothing actually changed.
Right.
It's just pure speculation.
And also, think about the example that we sometimes use in our workshops where the Challenger taking off.
Yeah.
And then you have those companies that were making the parts for the Challenger.
Right.
All of them, their stock price went down slightly, but one of them went down significantly.
And stayed down.
Yeah. And it was the company that made the O-rings.
Yeah.
So you look at that and go, well, who... all the stocks went down, but not much. I mean, a couple percent right off the bat, right?
Yeah.
With the 3 companies that made the other parts of the product, of the Challenger, right? But why did the one that made the O-rings go down so much is because their profitability, it was pretty certain that the profitability of that company would be hurt by what just had happened.
Yeah.
Because they may not be the company that makes parts for the Challenger anymore, so therefore their profits go down. But that's what the market is responding. Their profits didn't have a chance to go down yet when the Challenger exploded. We didn't have a chance to see the new earnings be lower. It was the expectation that they would be lower, and with good reason, the expectations were there.
Yeah, they'd had prior problems, was the deal. That's why it dropped so quickly. Is there had been earlier reports before the Challenger even took off that there were some issues with the O-rings. And theoretically, they were resolved or whatever. And it takes off, and all of a sudden people are like, oh, I guess there were issues with O-rings.
Right. It was confirmed.
Bam.
Yeah, for example. Yeah, so, that to me that explains when you have these big market movements. And you have people, they'll have I was just having a conversation with a friend of mine just before the show started, and we were just going back and forth about currencies. People going out there scaring that, hey, if we go to a digital currency, we go to the gold-backed currency, then what'll happen is our fixed income investments are going to be holding value and everything's going to be great there, but the stock markets will be necessarily decimated by that. And, I think so often what happens with fear, as we know this physiologically, what happens is the front part of our brains shut down when we get into fear and we stop thinking. Because here's my thinking regarding any of these things happening that we're talking about here is if, let's say we go to a digital currency, let's say we go to something gold back. I don't think that it's terribly likely, but if it were to happen, it's not something to worry about because I am going to switch to whatever that currency is as a company owner, and I'm going to accept that currency from now on, and I will be exposed to it, and I'll be an owner of that currency, and my company will be valued in that currency as well. Yeah. It's not an issue. I don't worry about those types of things.
Cheetos will be 32 Republic credits or something like that.
Yeah, there you go.
Well, it's interesting because as we were talking about this pre-show, I had a client that brought in some money from civil, was that Revolutionary War? I think it was Revolutionary, where the actual manufacturer printed their own currency.
There you go. I mean, banks
and
used
so
to.
when you work for them, you got paid by, this was Vermont, so
the
Vermont,
company store.
Vermont Steel or whatever it was. And then, you went to the bank and they said,
what a great example, Danny.
That's a great company.
Yeah.
We expect that place to be around. So we'll accept that currency.
Yeah.
And Evan and I were kidding about currency used to be beaver pelts, right? I'll trade you my beaver pelts for a bottle of Jim Beam, Jack Daniels, I guess.
Right. But I would much rather own the company that's going to decide whether they're going to accept the beaver pelts or, so I think it's a really good example right there. But, we kind of lose track of that. My company is going to be selling for 16 beaver pelts for every $1 beaver pelt earnings. It's just going to be what ends up happening.
That's a new marketing campaign, man.
Yeah, you like that? Should we go with it?
Our planning fee is 3 beaver pelts and
Peter won't like that.
There you go. I think that's a plan. So that kind of leads to something that I was going to talk about here, and
I think you should.
Yeah, I think I should. I really think I should, because we talk about gold standards, and are we going to go to a gold standard? Are we going to go back to gold? And should people be investing in gold? And you hear that all the time, and I was one of the things that I've been hearing all the time in commercials is that gold is a great inflation hedge. It's going to protect you. The dollar's going to go down in value. You need to own this as an inflation hedge. It's going to protect you and blah, blah, blah. And, the reality of it is, like Forbes had an article about this very topic a while back, and I thought it'd be probably good to revisit it. But basically, if you look at the history of gold as a protector against inflation, it's just not a good hedge. It's non-correlated in reality. Well, let's go back to the first half of 2022. You had the demand for gold increasing 12% year over year. And what happened is consumer prices went up 9.1%. Year end in June of 2022. And if you look at the research from 1974 through 2008, there were 8 years when the inflation was considered high, during that period of time. But during those periods of time, gold prices rose an average of 14.9% per year. So literally what happens is that people look at that and go, oh, that means that it is something that is a good hedge against inflation. But when you look back in history and really examine the data, it's not quite that clear that it's a great inflation hedge. You go back and they pointed out in Forbes, it says lessons about gold's track record as an investing hedge may be learned by going back to the 1970s. U.S. experienced high bout of inflation. Oil prices, shocks, and energy shortages drove average annual U.S. inflation up around 8.8% between 1973 and 1979. Gold did fine during that period of time, went up during that period of time. Then you look at 1980 and 1984. Inflation is 6.5%. Pretty high.
Yeah.
I mean, look at it compared to now. It's as high, if not higher, than it is right now. And it says gold prices, though, fell 10% on average each year. 10% per year. I mean, you should do the math on that. That's not so great. Not only did it fall short of inflation, losing money, but it underperformed real estate, commodities, S&P 500. Average inflation averaged from 1988 through 1991, 4.6%. But gold fell 7.6% per year on average. So if you look at it and say, well, what is a hedge? A hedge means that it should rise in line with sharp increases in consumer prices. And the reality of it is we're not seeing that. During the most recent extreme movements in inflation, U.S. gold has been, it was very mixed. It was back and forth.
Yep.
And so the reality of it is, as a hedge against inflation, it's just not a great hedge. It is marketed that way. And remember, never forget, as when I talk to the other guys on the station, I talk to Matt and Dan and Chris, and we all talk about that. Chris is always the first one to bring it up. He goes, I'll never forget, Paul, you said that. You made that point, that why is it that they are willing to take your dollars for their gold if they really think that the dollar is going to be destroyed?
Yep.
Totally. Why do they do that?
Well, and even from an academic standpoint, in principle, you don't use something with extremely high volatility, gold, price volatility,
yes,
to hedge something with low volatility, which is the inflation rate. It may go up or down, but not in enormous swings, and yet you have, whatever, gold has a standard deviation of like 25 or something like that.
It's higher in the stocks, yes.
And inflation's, fluctuates 3 or 4%. It just doesn't even make academic sense. Now, if you go back 200 years, not 10-year periods, sure, an ounce of gold has been a pretty good store of value long term.
Right.
But not as some kind of short-term play to quote-unquote hedge inflation.
Yeah, Dane.
No, so just going back to our currency thing, it used to be used as currency. You could go in to the Long Branch Saloon and give Miss Kitty some gold nuggets, and she'd give you a cold beer.
It wasn't a very practical currency, but
no, but it was. But, and we talk about it nowadays. What?
Yeah,
Miss Kitty.
Gold is good for jewelry. Okay.
Yeah.
You can't go to McDonald's and get a Happy Meal with some gold.
Well, and the dollar was backed by gold, so you actually
Right.
had gold certificates.
right.
But, the thing that Forbes points out, and it's something that I always point out in the Forbes article about this, that it's a little ways back, about a year ago that this article came out, but it's, dead on right. What are the best inflation hedges was the question that they asked in the article. And it was this one person saying, I'm always surprised how often investors forget that plain old stocks hedge against inflation over the long run. Of course, stock valuations may fluctuate with the day's economic news, but across multiple business cycles, market indices have significantly outperformed inflation. And then, you can also look at, like for example, I bonds are another example of something that could protect against inflation. And you might have something like TIPS in a portfolio, Treasury inflation protected securities, which would be, in a portfolio. But the reality of it is you look at these things and go, okay, what do we do to protect against inflation? Well, you've got to define inflation, as I always say. What is it? It's prices going up. Who's raising prices? Companies. That's why we want to own companies. But because the short-term fluctuations in stock markets, and they will happen, they're typically not that long. Market downturns, they don't last that long. But what do? We have fixed income investments, and part of that may be I might have. But you also look at regular savings accounts as well. What happens with regular savings accounts when inflation goes up? Go back 10 years. What was inflation? Non-existent. What were interest rates at banks? Not existent. Right? Now what's going on? Higher inflation. What's happening? Higher interest rates at banks.
Yeah.
So we have treasuries themselves protecting. Now, the issue that you have with I bonds is you have a really, really tiny fixed rate on the bonds and then an inflation rate on top of that. And then you also have the penalties for pulling money out early because you lose interest. And then you have the limitations on how much you can put in those bonds, $10,000.
Yeah.
So that's why more people don't use that. It's because it's a very limited. And then think about this. I'll leave this segment with this thought. Think about who is setting the interest rate on inflation that these bonds are going to pay as your interest? The government. That's right.
And we trust everything they say.
Yeah, exactly. So who's setting and what would they want to do, because it's debt that they are incurring, and it's more debt they are incurring if the interest rate is higher. Their desire is to keep that interest rate as low as possible, and thereby the inflation rate may be a little bit lower. So you look at some of these things that might be hedges, quote unquote, and I would look at that with a little bit of a skeptical eye, but just call me a little bit cynical. But you got to be thinking about these things. Fearing losses, banks are quietly dumping real estate loans. It's not quiet anymore. They went and put it in a newspaper. What's the idea behind that? Come on, guys.
Our secret 2-for-1 sale at such and such. Yeah, okay.
I get a kick out of that kind of stuff. So Wall Street's banks worried that landlords of vacant and struggling office building. But, this goes along with, as I've often said, you see people that don't diversify and they think that real estate is safer, as a result of it. And you go, well, they're going to be dumping loans. If they're going to dump loans, they're not going to lend. What are they going to do with interest rates if they're worried about lending to people that are buying real estate? That is an upward pressure on real estate loan interest rates, right? And but they're just basically talking about how it's an early but telling sign of the broader distress brewing in the commercial and real estate market. But how many times have we guys over the I'm saying you guys and I seen people walk into our office with investment portfolios, and they've got real estate funds in there, real estate investment trusts and limited partnerships and those types of things that have been sold to them by investment advisors that you just go, why are they doing that? Why are they concentrating in that? Because it sounds good from an income standpoint that I own a piece of real estate, and real estate, you have to pay rent, and then you have an income source and it's stable. And the reality of it is, this is why you diversify very, very broadly in lots of different asset categories, because you don't know what's going to happen from year to year. Mm-hmm. You don't know what's going to happen, where things are going to be going well, where things could be doing poorly. We talk about like CDs or anything fixed income investments. If I put $100,000 in a CD, or I put a lot of money in a CD that pays a fixed interest rate, and all of a sudden, these concerns that people keep talking about, that the dollar goes down, that it goes away, that inflation, or that you have a devaluation, or you change currencies, or whatever, then basically they only have to give you back the money that you gave them with the interest, which would be worthless because the interest was, same dollars.
Insignificant, yeah.
You're paid in dollars still. So you don't have that protection anytime you walk away from diversification in any way, shape, or form.
Yeah. Real estate, a lot of times I think it's spoken of in the abstract when people, particularly if we're talking about it in an investment portfolio. I'm not talking about someone that is a real estate person, but just an investor that's adding a REIT, real estate investment trust, or something to your mix, or your advisor has added that. It's still not a, fixed game. COVID, if nothing else, taught us, okay, occupancy rates could change. And, typically, back in the days when I was on the dark side, we would emphasize the strength of the tenant when we were selling these REITs. TGI Fridays is one of the tenants. Tractor Supply is one of the tenants. And, nursing homes. People aren't going to quit going to nursing homes. And, well, that's fine if all of those companies stay in business, if they can keep people in staff, and all of a sudden taxes may go up. We talked about costs going up to people just because of heat, that the insurance companies don't necessarily cover just heat damage or extra storm damage, and so they're closed for a while. It's not like a CD. Real estate is not like a guaranteed investment. There's a lot of moving parts that can make it not be very favorable very quickly.
Yeah, and not the least of which could be tax law changes, could be, fluctuations in, like you said, interest rates. It could be fluctuations in, let's say, who lives in a certain area, demand for real estate for those reasons. There's just a lot of things that can create problems. And anytime you own stocks, as I always say, you own lots of real estate already.
Exactly.
Right.
Yeah.
Yeah, I mean, typically, well, these REITs could be apartment buildings, but typically I think of the skyscrapers I always talk about. And so, but they're affected by economic factors. I know, for instance, a very close friend of mine involved in that business was a partner in a building in Houston that was 90% rented by ConocoPhillips for 20 years. Okay, oil company.
I was just going to say, I think I see exactly where you're going.
Right.
Really good.
Yeah, oil prices fluctuate just like every other asset class, real estate. And when those oil prices went down, they didn't have the capital or the need for all that office space. So the REIT was paying like 9% because it said, hey, ConocoPhillips, everybody needs oil, everybody needs. No, it didn't pay 9% in those years of recession or when the oil prices went way down to $26 a barrel, if anybody remembers those days.
Yeah, and it doesn't have to. I think that's the other thing.
Right.
If you buy it and they say, oh, it's got this 7% yield, today it does. That doesn't mean it has to stay 7. It's not a guaranteed thing like a CD you were talking about or a bond rate. It's, well, today it's 7, but it could be 3, could be 0.
Could be 0.
We just hope to sell the building.
And we see it all the time. Where all of a sudden now you can't get rid of it because nobody wants something that just dropped in yield significantly.
Yeah.
And you can only sell it to some third party that's willing to come and pick it up for pennies on the dollar.
Yep.
So we've seen that time and time again. And, that's why I think so often people don't trust, the investment advisors that I talk about when they're commission-based and they get paid selling products is because they've been burnt so many times before. And that's why we constantly preach that. We always talk about that because it is something to be concerned about. Quite often the conflicts of interest that are created there create people that actually say things that I don't know if they believe it or they don't believe it, but that's what they're trained to go out and sell.